This is video lecture 1-1. Uh, in it, we're going to take a look at a little background on uh, managerial accounting, and we'll begin by talking about how it's different than financial accounting. Remember, when we talked about financial accounting, we said that we were servants to the external user. That is, we provided historical information to external users that they could take and make predictions about the future. Managerial and cost accounting differ in that the purpose is to communicate to internal management data that is future oriented, and that will require the use of projections and judgments and estimates that they can take and make decisions about. In financial accounting, we left the projections and judgments to the users. In cost accounting and managerial accounting, we help management by analyzing the data and making future-oriented projections on data. And the purpose of this is to control the results of the operation of the entity. In financial accounting, we had a series of rules and standards that were called GAAP. We have an external party, the CPA, who audits the financial statements. In managerial accounting, there is little crossover between financial accounting GAAP and cost accounting. We'll talk a little bit about that when we talk about full absorption costing that is done to determine the product costs that make up both the value of inventory and the recognition of cost of goods sold. Outside of that, there is very little crossover between GAAP for financial accounting and the application of GAAP in managerial accounting. So it's pretty much self-driven. The rules that you're going to apply are going to be based upon company policy and best practices. The criteria that we use in applying the rules, cost versus benefit, does cross over a bit into the concepts of GAAP, but much more heavily associated with managerial accounting. That is, we will not set up systems to collect and analyze data if they don't provide a better benefit or a the benefit of them does not exceed the cost. Financial accounting is historical. In managerial accounting, we could have some short-term planning and some very long-term planning. So it can be within 1 year or greater than 1 year. And again, in financial accounting, as we spoke of, there are tendencies or at least temptations to fluff up the numbers to make it look like the financial position or performance of a company is better than it actually was. But we have the same types of issues that pop up in managerial and cost accounting, and as we go on, we'll talk about some of these behavioral issues. So, in short, financial accounting is for the external user. Because we are dealing with the public, the profession has set up many rules. In managerial accounting, we're dealing with internal users, and we are going to set up our rules that best fit the needs of our internal users. So there are no GAAP rules as relates to communicating with internal management. Managerial accounting information is used to plan, manage, and control the operations of a business. A business begins with a strategic plan. If it's a new startup business or the new product line for an existing business, there will be a formal business plan established. The formal business plan will talk about strategic objectives, operational objectives, and have financial planning information, projected financial statements. We will then take these plans, develop, particularly in the financial area, a budget, and then we will implement our plans. Once the plans are implemented and put into operation, we're going to be collecting data. This data will be used by management to ensure that the plan is coming to fruition. So we will collect data, report it to management. There they will analyze it. We will compare it to our planned results, and if our performance does not meet our plan, we need to make changes. We need to activate some decision making, and through this process we will control the operation and the results of the operations. We will periodically and systematically revisit our plans, fine-tune our plans, and the cycle continues. So cost accounting is all about planning, gathering data, providing feedback, and controlling the operation. Let's talk about cost. And cost is different than expense. A cost can become an expense when we cannot match it directly to a product. These are called period costs, and we expense period costs based on a time period, not on the matching of revenue from the sale of a product to its cost. A product cost, on the other hand, will have an intermediate step. The cost of creating a profit, the material, the labor, the overhead, will first be capitalized in an asset account, which will be some type of inventory, where it will be held until it is sold, at which time we'll match the cost of the sale to the revenue that it generated, and we will recognize cost of goods sold. So again, the conversion process will take capital. It will allow us to purchase material, hire labor, and incur costs that it takes to take that material and labor and convert it into finished goods. So in our first demonstration problem that we're going to do in class, we're going to take a look at product costs and see how they work their way through the accounting system.